Welcome to Startup Victoria's Melbourne Lean Startup event. My name's Erin. I'm one of the Startup Victoria team who organised this event, and later on this evening I'll be introducing lovely Michelle, who's also part of the team, and she will be hosting the Fireside chat with Jonathan Teo. We couldn't organise a fire, but I'm sure we'll make sure it's nice and intimate. So, just quickly, the agenda for this evening. First up, we have a few words from our sponsors, and sit tight, because at the end of these we'll be giving away some great prizes. Then we'll kick off with the main event, the Q&A session with Jonathan. And just so you know, we'll try and finish at 8:30 this evening. We know that you're all eager to get home or come to the pub with us. Okay, so tonight we have a Twitter hashtag. We'll just bring that up. The hashtag is LSMELB. And if you'd like to include the URL for Startup Victoria, it's startupvictoria.com.au. Alright, so our first sponsor for this evening, a big thank you to our new major sponsor, National Australia Bank. And Nathan from NAB will now say a few words.
Well, thanks very much everyone for coming along. I'd like to talk a little bit about what we're doing at NAB to foster innovation, and in fact many of you may not think about NAB as an innovative organisation, but I actually like to think of us as a quiet innovator, and as someone that's been involved in a lot of new payment initiatives over my career, it's actually really good to work at NAB at the current moment, because we've got a lot of really interesting stuff going on, as well as a great heritage in new solutions. So what you may not know is that NAB was the first bank to introduce a transparent redirect solution on our payment gateway. So not only are you able to transact securely, but your customers and the applications that you build are also able to transact securely with a bank strength payment gateway. That payment gateway is also the only one that, besides some of the offshore gateways, supports multi-currency, and we know that many of our startup customers are driving for a global market. We've got some bankers here that would love to talk to you about how you can get started and support going global, but still thinking about being local. What else have we done? Well, did you know that if you're selling into China and you're using a Visa and MasterCard, you're twice as likely to get a decline as you are to get an approved transaction. So from NAB, what we've got is a link with China Union Pay that your customers and the customers of your customers can buy with their Union Pay card online. So again, it's something we'd love to talk to you about, because it will help you sell a lot more into the fastest growing market in the world. So we all love EFTPOS, but is it really something that is innovative, and is it something that the apps that you're building are going to be able to work with? What we think is that you need more smaller and faster payment options, and what you'll see coming out from NAB in the first quarter of next year is a micro pin pad that is about half the size of an iPhone. So not only will this work with iPhones, it'll work with iPads and Android devices. So again, this is the part of what we'd like to have you start to think about NAB as being part of your innovation community. And finally, along that theme, it's not just about putting up a brick wall, sitting behind that brick wall of security and coming out from that when we see fit. NAB has done a lot over the last couple of years to work a lot more with innovative companies like yourselves, and some of the partners that we've signed up and are helping to grow their businesses in Australia, like Braintree and Stripe and Pin, are very much part of our ecosystem, and we'd love to have all of you as part of our ecosystem as well. So thank you very much. Didn't want to say too much, but plant some seeds of thought and definitely think about NAB for your payment solutions.
Thanks, Nathan. Okay, so another sponsor we've got tonight is BlueChilli. BlueChilli is a technology and software development company that creates online web applications and invests in software development in online startups, an investment strategy they call venture technology. And if you'd like to know more, Joe is in the audience somewhere tonight. We also have to say a big thank you to the Investors Organisation for bringing Jonathan out to Australia. Investors Organisation is a network of experienced technology investors and business leaders who are looking to support the next generation of Australian startup entrepreneurs through collaboration and idea exchange. Brian from Investors Organisation will now let you know a bit more.
Thank you very much. I knew not to wear the suit tonight. I said in my diary, no suit, going to a startup event. I turned up and I thought, I've only got my smelly sports stuff in the car, I'll stick to the suit. So I apologise for that. Well, thrilled to be here and together with Adrian Stone, who have had a great week. Not so much a hobby, but a serious hobby is we've got Investors Organisation. I've been in the startup space more as a trademark attorney and IP advisor for over 10 years. Love the space, love everything about the startups, love advising them. And the best way we thought we could do that was to stimulate all the investors in Australia and keep educating them, getting them involved in the startups and to show real interest in what's happening in this scene. So to Scotty and everyone that organised tonight and all of you guys, it's sensational to see you all here because that's our purpose, is to keep stimulating the investors to consider you guys, because then we can make a real difference. And we have had an unbelievable week bringing out... I'm not doing the official introduction, but I can tell you we've got a genuine Silicon Valley star with us here today, and we've had the privilege of getting to know him and really raising our knowledge, and hopefully some of you will get something from tonight. If we keep raising our knowledge and building that foundation, and I guess that's what I've been doing over the last 10 years, is building the foundation for startups, whether it's getting your trademark in place, your patents, your IP, your legals, your accounting, or really your value proposition, your networks, your groups, getting that all in place so when you do turn up to investors who we know and we're connected with, that you're something they really want to look at, you're appealing, you've done all the foundation, and they really want to look at you. Because believe me, they're interested, but you've got to get yourselves right first. So thanks for the opportunity tonight to bring Jonathan, and we hope you get something out of it. Thank you.
Thank you, Brian. Okay, we also need to thank the Kussowski Brothers. They're filming this evening, and they specialise in social media content creation and infrastructure, which involves the production of a series or single marketing and promotional videos. They've got a special deal for Lean Startup members, and I'll let Lucas introduce that.
Hi guys, wow, yeah, it gets bigger and bigger each month. So I'm Lucas from Kussowski Brothers. My usual social media package for startups, or for businesses actually, is for $1,500, but for startup members I've slashed it by a third. It's for only $500. So like Aaron said, it's a video or series of videos combined with photos or any kind of content you want. So I'm a content creator and I want to create content for all of you guys, and it doesn't just start with me. I tend to expand into a big, large cooperative within the next 5 to 10 years. So you'll be seeing a lot of content creators blowing people's minds. So thank you very much, guys, and see me after the show for a deal. Cheers.
Thanks, Lucas. And lastly, thank you, Inspire 9, which is a fantastic co-working space, and generously provide the venue for this evening. Firstly, we've got not a prize, but a special discount offer for you from the guys from Startup Weekend organisation. They're running an event called Startup Weekend. It's happening from Friday 5:30 p.m. to Sunday 8:30 p.m, November 15th to the 17th. So that's a big weekend. It's happening at the York Butter Factory on King Street in Melbourne. And we've got a link there to their Eventbrite page and a promo code for getting 10% off. And I think it's about $99 a ticket, so yeah, great value. Next we have Products Are Hard. 2 free tickets to an event called Products Are Hard. I'm sure this event will make them a little less hard. To give away this, I welcome Albie.
We're from San Francisco. This is a conference we've been doing for a couple of years, and we decided to take it international. And so Melbourne is the first place we're doing it outside of San Francisco. So you're very special. You were chosen for your vibrant startup scene. It's about product management as well as just business processes in general. We've got speakers from big companies like AFL.com, Redbubble, PIN actually, and as well as very small local companies like Love Shack and Moore's Cloud and all kinds of different industries, software, hardware, etc. So it should be very exciting. We have all of you should come. We have a 20% discount code, LOVECoworking, for those of you that wish to register. It's at productsarehard.com, and there's a link right at the top to the Melbourne edition. And for 2 lucky attendees, we're going to give you a free ticket. And this is Wednesday, this coming Wednesday, at Acme in Fed Square. And we're very excited. It's the first time we're doing it outside of San Francisco, so it's both scary and exciting at the same time. And some of you have also met Claire, who's one of our producers over there. So if Scott has the magic box, then I can pull up the names.
Scroll.
So, just gonna sort of imagine the wheel spinning. Okay, Hunter Palmer. Do we have Hunter Palmer? No? Yes?
No, I think we've got it.
No, no Hunter, sorry.
Go back the other way.
We have Carison Garcia. No. Yes, okay. That's 1. And 2, Indiana June. Yeah? Okay, beautiful. So again, productsarehard.com, love co-working for 20% off this Wednesday, 2 days from now, and hope to see some of you there. Thank you very much.
Okay, now we've got NAB have very generously got a prize, which is a mini iPad. So I'll hand over to Nathan.
So we prepared this one earlier. I don't know if that's us being organised or just for fun. But Phoebe, you. Very nice.
I do use NAB. So yeah, I do bank with NAB.
We didn't organise that. I didn't even do any searches. Can I just get, while we're up here, can I get the bankers in the room to raise your hands? And guys, please don't target them after this. Yeah, cheers.
Okay,
Congrats.
thank
We'll be in touch.
Okay, now we come to the main part of the evening. I'd like to hand over to Michelle, and she'll introduce Jonathan and take it from here.
Thank you. Hi everyone. I think we've only got 1 mic, so I'm going to have to sort of disattach this, if that's such a word. Okay, so next we welcome Jonathan Teo, whose official title on LinkedIn is Tech Nut. Jonathan is the Managing Director of General Catalyst, and he's back out in Australia who, I think, to have secret government meetings, do a bit of a tour and of the startup scene and that kind of thing. So now it's not easy to tell just what ideas are going to take off, but Jonathan seems to have mastered the magic formula. At Benchmark Capital, he led early investments into Twitter and Instagram, which we all know sold for something like $1 billion to Facebook 2 years after it started. And at GC, he led a recent investment into Snapchat. Who's got Snapchat here? Hands up. Who's got Facebook? Who's got Instagram? Okay. Before playing with money, he was an engineer manager at Google after finishing an electrical engineering degree at Sydney University. So let's welcome Jonathan. Are you excited to be here?
It's a great crowd. It's a big crowd. It's great. It's nice to see the whole community coming together.
Yeah, absolutely. I bet. Okay, so I have some questions for you, and I'm sure that the crowd does too. But we'll ask a few questions, kind of like 15 minutes or so, and then we'll hand over to you guys to do the rest of this fireside chat. So get your questions ready, because I know I'm sure you've got some percolating away there. Now, Jonathan, let's start a little earlier in life. What was the startup and tech scene like here when you were first deciding what to do at uni?
Wow. Here as in Australia, I wasn't that exposed to the tech scene. I was very much just an engineer doing my thing. Was involved in a little bit of the bulletin board system community. Just did my own coding on my own. Taught myself programming. More out of interest than to develop any kind of specific applications. So I wasn't that involved in any tech community, if there even was one. I just did my thing.
That's great. And can you tell me now, because we heard that at uni you were a bit of a badass. I don't know whether anyone else has heard this, but it wasn't for hosting underage drinking parties, it was something else. Now, what was that?
I got kicked out of a few schools growing up, 3 schools. In Sydney Uni, this was back in the day when it was exorbitant, the amount they charged for you to get internet access. And, I always had to believe that if the infrastructure exists and it's available and it's free, information should be free, the availability of it at least. So I spent some time just helping people get free access to data and information and content. So
now, what they did with that?
Yeah, what they did with it, I don't know.
That's their own business.
Yeah, you got to make a good judgment call on that.
Very good. And then after uni, after college, you started working at Google. So how did you just kind of fall into that job? Or because I know that Google sometimes pops up these, billboards, and they put algorithms on it, and then you can't even get a look in until you do something like that. So was it just kind of submit the resume and get in, or was it, something more
That's a good question. I've never actually been asked that question, but I was actually brought into Google by a mentor of mine that I had while I was doing grad school in California. And he basically pulled me in to help figure out how to scale out the data center infrastructure of the company. And so it was a week and a half long process of me meeting a team and then finally jumping on board. I think they told me at the time it was a record from first initiation to an offer. So
wow.
I joined the team, and it was fun.
Yep. And what did you learn? Because you headed up some kind of R&D department in Shanghai, is that right?
Well, I was initially involved in building out the data centers across the world, really. Google at the time had a competitive advantage around how its data centers were built and deployed, and the constraint wasn't really the building of the data center in terms of how you did it or whether you could hire people to do it, but it was really a constraint on places, space. There are only certain locations around the world where you have access to cheap power, you have connectivity, you have political stability, and you actually have a workforce that you can bring on to do this. So, if you think now about all the companies that are out there building data centers, they're having a really hard time finding space to build 10, 20, 60, 100 megawatt, even 1 gigawatt spaces, and that's just a pain that a lot of companies face.
So when do you think it's going to move to the moon?
Move to the moon.
Data
I don't know if it'll move
to the moon.
Yeah, the bandwidth is probably not going to make the cut.
Yeah, there's certain issues there.
It'll move into the ocean first, and then
maybe
move to the moon.
Maybe a satellite somewhere positioned in between.
Possibly, yeah, in the sky.
So then after Google, what was it that then led you into the investment world? Because it's kind of like you went from building out data centers to investment. How did that happen?
Well, after data centers at Google, I worked on international R&D growth. So figuring out where around the world different products needed to be built, how do you structure the teams around the hypergrowth that Google was going through at the time. And it was during this period that several folks from the investment community reached out because they were trying to figure out what a cloud computing strategy should look like. And the technical depth required was, at that time, because a lot of innovation was at the infrastructure layer, it was pretty high. So I ended up being convinced to be part of a venture firm, Benchmark Capital, to think through what the infrastructure and data stack was going to look like in the consumer space. Yep. So that's how I started investing.
Okay, very good. So were these lucky, or did you have, as I mentioned before, a magic formula? Like what was your process? I mean, obviously you had a process for identifying stuff that perhaps wasn't so mainstream, but what was your process for identifying what was had the potential for success?
Yeah, well, when it first started out, it was really based on relationships. So there were people I worked with at Google, there were people I interacted with at Stanford that I had deep respect for in terms of the way they thought about product, the way they thought about engineering. And so when they started on their new projects and it started to take off in some way, whatever the engagement metrics were, it was a very easy conversation to say, hey, I'm representing a firm, we'd like to make an investment, let's make this happen. And it's extremely competitive in the Bay Area to make an investment in a good company. So those relationships really helped because they were 5-year-old relationships with Kevin Systrom at Instagram. I'd known him since 2006 when he was an undergrad at Stanford, or just about graduating. But over the course of those couple of years, as I was getting deeper into understanding how these consumer ubiquity pure play products worked, I developed my own thinking around what to look for, why it works, and how to actually help these companies scale out so that they become successful.
Yeah. And so what was part of that process? I mean, obviously it started off as relationships, but then what became kind of your sort of process for figuring out?
Yeah, I think we're all engineers. A lot of us are engineers here, and what we do is we hack away at the rules that exist, whether it's programming rules, or whether it's business rules, or whether it's just structural rules that are constraints. And what I did was I put a lot of my own structure around the kinds of companies that are going to do well as far as consumers are concerned, whether it's around figuring out what the utility was of an app, how the engagement model was working, what the growth model was working, how they work together. And every app is different, every product is different, every vertical you have to use different kinds of lenses to see what actually works. But at the core of it, at that time, was 2008, we've entered a very product-centric world. Distribution models had changed dramatically because of the rise of the social graph. And so it was easy to use that lens on a lot of companies with a few tweaks, because we are driven very much by product now. The old world of sales channels, of distribution, biz dev deals have sort of gone by the wayside. So I had my own structure to it. I had the types of metrics that I cared about that I usually dived into with entrepreneurs. Most of the time, entrepreneurs don't think too much about the metrics and the intermediary metrics that are going to indicate success. But that's a conversation I enjoy having with them.
So if you were to talk to some of the entrepreneurs that are here today, and I'm sure that there's many, what are those specific metrics?
Yeah, like I say, it's so different for each product. So
let's say it was I don't know, I think a lot of people are doing kind of not potentially social-based apps, but they require some kind of community, like a two-way community. So in a two-way community type app or either web or mobile app, what would be required there? So
maybe you're talking about marketplaces, you're talking about communications apps. Well, let's use communication app as an example. A communication app is really an app that drives engagement because you're providing a mechanism for people to exchange messaging. And for communication apps, communications is a mechanism by which you drive engagement. So it can be layered onto any kind of product that is providing a piece of content that is the context for that communication. Communication apps monetize by either the utility of it, vis-a-vis WhatsApp, they charge you for communicating, or Skype, or they monetize because at the end of the day they have strategic value as an aggregator of a demographic. That's how these apps grow. They grow very much virally or word of mouth. When you look at communications apps, you need to figure out how core they are to your day-to-day communications. And so a metric that you could use, for instance, would be your daily actives over your 7-day consecutives. For instance, if you are considered a daily active, and most communication apps have anywhere between 25 to 40% daily actives, out of that group of daily actives, how many of them use it consecutively for 7 days? If you're Instagram, I think at the time the number was probably around 20%, because it's not really a communications app, it's a broadcast app. Snapchat, through the roof. You wouldn't even believe what that number is. You wouldn't believe what that number is.
And do you look at retention as well over time?
Yeah, retention is core to growth. Most people think about retention as just engagement, but if you lose users out the funnel, you become form spring. You grow really, really quickly, but then it's flash in the pan. So how do you actually retain the users that you bring onto the platform?
Yeah,
It's core, yeah.
I know there's, I don't know whether any of you guys use Mixpanel, but that's one of the things that a lot of startups are tending to use now, because it allows you to get cohorts of retained customers, so you can see when a customer signed up at week 1, how long did you retain those customers, that particular cohort of customers for. So I think that can be useful, particularly when you're going to, an investor.
If you can afford Mixpanel.
If you can afford it. I think they've got free stuff to start, but I don't think it lasts long, particularly if you're doing a communication type ad. So actually we might hand over to just some of the crowd now, just for a couple of questions, because I was thinking maybe some of you have apps or things that you would want to ask Jonathan specifically about some of the metrics as well. Yes?
So I'm going to ask you an investment-based question. I know you already said it's really competitive for VC firms to invest in really good startups that have potential. So the SEC just changed their rules and are allowing things like following on to famous investors. Like I know Tim Ferriss has got a lot of follow-ons on AngelList. Is that making that whole market more competitive for you in terms of like looking at really good startups? And how do you see that going long-term in terms of the actual business of VCs?
Yeah, I actually think it's good for venture capitalists. I think it's questionable whether it's helpful for entrepreneurs. It's good for venture capitalists because it aggregates your deal flow. So you basically have one point of contact. You can go to AngelList and you see the whole range of startups out there. It's much like Y Combinator. For entrepreneurs, you really need to decide where this capital is coming from. It's so capital efficient these days to build a startup, because over the past 7-8 years, we've consumerized the tech stack, right? Anyone can build a tech business. Not anyone can build a tech business, but it's a lot easier than before, and the cost structures are so much lower that you don't really need to raise that much. Now, the thing about syndicates is that it brings a lot of non-value add investors to the table for your startup when you're at a stage where you need the highest leverage help possible. So that is one issue that you need to think about whether it's helpful for you. But secondly, most of these rounds are done as notes. And what happens with notes, especially if you have a good syndicate, you end up raising a large amount on a note. It could be a high cap, it could be a low cap, but irrespective of that, it has to roll into your Series A. And so you end up having enough capital to go a certain distance, but then you want to, with every funding round, you should be thinking about how it affects your following financing, the next round that you're going to take. And with a large seed investment that rolls into your Series A, it is to a large extent a disincentive for a good Series A investor to come on board and really put in effort. So by taking a large syndicated round of low value add capital, if it's low value add capital, you end up finding yourself in a very binary position where you either do extremely well, where a follow-on investor is going to be fine taking a smaller chunk, or you're dead in the water. So you have to make that trade-off. I think it's fine. The whole capital ecosystem is going to just find its way to balance out. It's not going to affect the way we do our business. Yeah.
Yes.
Hi. Jonathan, so in Australia we have a different marketplace of venture capital than perhaps you have in the Valley. We have a very elastic demand where there's a lot of startups and not much capital. So we actually don't do a lot of convertible notes in Australia. So what was it like for you back in, let's say 2002 is probably comparable, when there was not, well, maybe a little bit later, when there was not a lot of money around and there were a lot of startups? How did you guys get through the challenge of raising at that early stage?
Can everyone hear people asking the question? Is that okay? Do you need me to repeat it?
Yes.
Yes, repeat it? Okay, so convertible notes, basically that Australia doesn't raise using convertible notes. So back in 2002, I can't remember the rest of the question, or a little later.
Because there is such low valuations in Australia, you get a Series A round of maybe a $1 million pre, whereas in the US you have 4 to 7.
Yeah.
Can I take a step back here? How many people know, because some people have, probably know a lot about investment stuff, and we're talking about a lot of stuff here that some people may not know, convertible notes, all this kind of stuff. Can I just check around the room who knows what we're talking about? And should I get, yep, okay. Maybe I'll just get you, Jonathan, to just give a really kind of brief overview, just to give them a bit of grounding, and then answer your question just about how series of fundings work, and how it generally works in kind of a structured environment.
Sure. So you can either raise capital on equity or raise on debt, and a convertible note is a very cheap way or easy way to raise it on debt. And typically so it means that if you actually want to raise $1 million, let's say on a note, you raise $1 million from folks, you promise that at maturity, usually anywhere between 18 to 24 months, you'll pay it back with a certain interest. But one of the things that's unique about a note is that it's convertible. And so when you do raise a priced round, that amount of money that you raise converts into equity at that round. So that's a convertible note. Price round, basically you're raising it and you're giving up equity in your company for the dollars that you take in. I don't know what happened back in 2002, but I can say that the issue about raising here in Australia with much lower valuations, coupled with, I mentioned this before, around the equity mindset that is less prevalent here around hiring, means that companies in Australia do tend to have a higher burn. They have a higher burn, but because valuations are a function of demand, and there's just less capital in Australia, you do have lower valuations, which means that investors tend to take a larger chunk of your company. This doesn't set up very well for follow-on financing from a quality investor that still keeps a founder with enough equity for an investor to feel comfortable that he's motivated enough. So that's an issue that hopefully will be solved over time. But I think investors do need to get together and be a little bit more cognizant of, what an equity mindset is, how capital actually can play its role at different stages of a company's growth.
Excellent. And I just wanted to ask, how important is that, because we sort of talked about confidence in the co-founding team or in the founding team, how important is a founder or co-founding team, and what's most important, I guess, in that relationship between them and or their attitude as to, I guess how potentially good the investment might be.
Having a founding team is critical. It's all dependent on the team, especially at the start. You want to find someone that you can work with. I mean, a lot of decisions you're going to make as a startup founding team is based on very ambiguous information. You're making a lot of gut calls. You better trust that the person you're working with has your back. So, founding teams that work typically have working relationships before. They've worked with each other. They understand the different skill sets that each founder brings to the table. And founding teams need to be self-aware to a large extent, because you do need to build up the different skill sets that are going to make you successful. And unless you're aware of what you can and can't do, it's hard to bring those people into the team.
And how much do investors actually look at the dynamics and the skill sets of the founders themselves in making a decision around the business as a whole? Like, would they potentially overlook or help them with perhaps a part of the plan that's lacking if they felt that this was a really dynamic team?
The most common reason an investor passes on investment is because of the team. And they may not tell you that because it's a hard message to put across the table.
Yep, okay. Does anyone have any questions about teams or founding teams? Yes?
You've talked about the metrics that you use and now have strayed a bit into the teams. How much does the experience that you have come to bear on this? It's not a quantitative element.
So how much does Jonathan's experience have to do with the founding, or I guess making decisions?
Yeah, making the basic decisions.
Qualitative versus quantitative.
Yeah, I mean, you can meet an investor and he may or may not invest in the company, and it's for so many different reasons than just the quality of the team, quality of the company, quality of the opportunity. Investors, especially in any context, have different motivations, whether it's portfolio management, whether it's a particular interest in the space, for them to make the go, no-go decision on the investment. So for me, my experience plays in because I probably won't make an investment in an area that I'm not familiar with. I have a simple rule to not make an investment if I'm not an insider in the space. If I don't understand what metrics are important, there's no reason for me to make that bet. There are, however, situations where I would bet entirely on just the team. because you trust that that's a team, especially if you've worked with them before, or I would say only if you've worked with them before and you understand how they operate, that if you have the confidence they can figure it out and it's a big enough opportunity where no one is an insider, you make that bet. And a lot of firms do that, whether it's through a EIR program, Entrepreneur in Residence program, or whether it's a hatch that they do themselves and build a team around.
Excellent. And what do you see as some of the biggest missing components from startups when they go for investment, when they're presenting? Is it in the team, or are there also other components, perhaps in terms of their growth strategy or?
The largest component, the most common component that's missing is usually it's related to the team. It's largely a founder that is slightly unaware of the realities of company building. And I think investors want to work with entrepreneurs that have a vision for what they want to build, but also have the humility to understand that you can't know all the right ways to get there. And they're willing to accept advice, they're willing to accept the need to fill out even an advisory board or fill out their circle of employees and just friends that actually can help them think through these problems. Arrogant founders don't usually get funded unless they have either a proven track record or they've managed to show that their ambition is actually rooted in reality.
What about, I was going to thinking about Australian, because I know Australian personalities and in the tech startup space is probably quite different from the US. I think in the US there's a lot of confidence. In Australia it's just a cultural thing. There's less confidence. And I know you may not have been sort of fully involved in the Australian startup scene, but have you seen here that difference? The idea that rather than it being arrogance, it almost being a lack of confidence, which kind of trips people up?
I don't know. I haven't spent enough time with entrepreneurs here, but everyone here that I've met has been so much energy and passion and love for the idea of entrepreneurship. It's energizing. I think just events like this is definitely in the right step, because a large part of it is sharing information with each other. The biggest cause for a startup to fail is that you make all these mistakes that can be avoided. You run out of capital because you're using it to learn. Instead of using the capital to learn, and instead of wasting time, because opportunities come about just ever so often. And you want to capitalize on it and you want to accelerate through that opportunity. And when you come together as a community, you share a lot of common wisdom around how to scale a team, what to avoid, how do you structure your round, how do you hire a good lawyer, accountant, how do you deal with your healthcare, super, right? Stuff like that. It really helps you focus on what matters in your business, which really is the product, which is really sharpening your axe. Because all these other things are just going to pull you down. And if you can focus all your energy on the things that actually are going to pull you up, that's where you get the most success. So coming together, both as a startup community in terms of entrepreneurs, as well as investors, as well as experienced entrepreneurs helping out, I think that's crucial.
Yep. And is there a time, because I think sometimes I get a sense that there's a stigma sometimes around going for equity, raising money that, oh no, we're going to bootstrap, or is there a time when it makes sense to bootstrap? And so what's the best time to bootstrap? What's the best time to, go and find money?
If you can bootstrap. If you don't need to raise outside capital, don't raise outside capital, because that capital is so expensive. It's going to cost you a lot of equity, especially at an early stage, because investors think about all the risks that he's taking on. So if you can bootstrap. A lot of companies that are going after ambitious enterprise vision or ambitious consumer vision, or in the consumer space, going after a ubiquity play where you're going to monetize via advertising, so you actually need to build up an audience before you actually get to charge anyone for it. You do have to raise venture capital, and in that case you better find someone that has complete alignment around how you think about that business, because otherwise you're going to you're going to be frustrated because they'll get impatient.
Yep. And you mentioned before about planning for raising capital. How would a startup entrepreneur here today go about doing that, and how much is it dependent on their business, and what are the things that they would need to think about if they wanted to start planning?
Planning to raise capital. You raise capital when you need it. So, unfortunately, not everyone has the luxury of having the leverage of growth. Growth, if you have growth in your product, in your company, you can raise capital from anyone. Most of the time, we have an idea, we want to build it, and you need capital to get it off the ground. So the best way to go is raise it from family and friends, because that's going to be cheap. You want to raise enough. Like I say, every capital raise should be with the next raise in mind. Whether it's an IPO or not, even an IPO should be around what's the next opportunity after a raise from the public markets. So when you're building a company and you need to raise capital, just think about how much runway you need, how much you can get in terms of the dilution that's reasonable to you to get to the next milestone. And the next milestone should have in mind what investor you're going to talk to, who's going to understand my business, and what are they looking for. There's no point, and this is one of the issues that I think will slowly get resolved here, is entrepreneurs actually understand how to build startups that are built with an equity mindset. Where you're investing dollars without actually seeing a business model type traction right away.
Yep. Do we have any kind of more specific questions about equity? And yes.
What's your opinion on crowdsourcing? Is that similar to...
Question is, what's your opinion on crowdsourcing?
You're talking about crowdfunding?
Sorry, crowdfunding.
Yeah. I think it's great. I think crowdfunding should be used as long as the company you're building is focused on consumer space and you actually have a deliverable that you can promise folks. It's a great way to go. A lot of entrepreneurs have done that to great success. And you get the capital, the working capital to build a product, and hopefully it catches the eye maybe of someone that has a much deeper pocket that wants to support you through that. But even if not, if your product is interesting, it's a great way to test it in the market and a great way to get capital. So why not? I like the idea of crowdfunding.
Is it popular? Sorry, part two. Is it popular here? Or I don't know if they do it here. I know they do it in the States. Just.
Yeah.
Okay. Yeah, so there have been a few crowdfunding successes. LifeX, who, if anyone came to our event a couple of months ago, they ended up raising, I think, over $1 million, and they had to stop raising because it was so successful. I've tended to see that when because I've looked into crowdfunding for my business, that it tends to be businesses that have a physical product, because then they can give something back for, how you have to give a special prize or whatever for someone who gives. It's so much easier to say, we're going to give you the product. All you're actually paying for us is for the production material. Whereas if you're saying, oh, you're going to pay for our lawyer fees and our IP and our, our marketing, no one cares. There's less of a buy-in. That's what I've seen anyway. So any other questions? Yes, over there.
So when you invested in Snapchat and Twitter and Instagram, you did one of the early investments before they were making money. So how did you value the company?
So that was, how did Jonathan value at an early stage Twitter, Snapchat, and Instagram at those early rounds?
Like I say, valuation is a function of demand, so it depends on how many other people want to invest. You really, if the company is interesting and it has traction, they do command a much higher valuation. And in that case, the entrepreneur gets to decide how much equity he's willing to give up. In the value where capital is so available, the valuation is not as important. It's about how much equity the investor can get for whatever dollar amount they put in. Because we tend to think about companies in terms of the potential. And there are investors that think about it on a risk mitigated basis. There are some investors just think about what's the biggest upside they could potentially get. And if that's the case, having 10% of a company that's going to be worth tens of billions of dollars is still a great outcome. So, you don't base valuation on anything to do with monetization because there's none. You don't base it on anything like growth because you could do that, but I'll give Snapchat as an example to Instagram. Snapchat, when I met them, they were 300,000 users, 400,000 users. This was in April of 2012. And by November, they had hit 3 million users. By February the next year, they had 10x that. So they grew really, really quickly. And the valuation they commanded in the last round was $800 million. You think about Instagram. Instagram, you know, when they raised their Series A, it was at a valuation of 27 million. And they had 1 million users. When Snapchat had 1 million users, or 3 million users, they were valued at about 70. So you can't really use any kind of historical on that. It's just how much are you willing to pay, how much capital is available, and how much equity are you willing to take.
Quick question. So like, how did you come to 27?
Sure. 27 million with a $7 million investment meant that you took about a quarter of the company, you know, just around 20% of the company, which if you think about how much that company needed to raise down the line, Instagram was, you know, burning for each user about 30 cents per user. Those were its costs. It needed capital in order to get to the next stage. Snapchat, which is a communications product, and you're sending images across multiple times a day, you can imagine your cost per user is much higher than that. So instead of just being 30 cents, it's a much higher number. And so you needed more capital in order to get it to the next point of inflection. And so you needed to raise more. And as long as you found an investor that's willing to buy into that vision of what you could become, that capital requirement determined the amount to raise and thus valuation. Does that make sense to people? Yeah.
So in terms of then the valuation for, say, local startups, I mean, I've heard everywhere from lawyers and accountants tend to be up at the upper end. They tend to say that anywhere up to 2 million, sometimes even larger, but definitely, you know, no more than 2.5. With, you know, people kind of in the entrepreneur space tending to say around 800,000 or 700,000 to $1 million. So when it comes to an Australian startup where you've really got that kind of valuation placed on you from the very start, and you know, they will come back, angel investors will come back and say, sorry, you know, you say that you want to be valued at 2 million, but we're just not going to buy into that. And again, it's because of this demand issue. How do local entrepreneurs deal with that, I mean, you could call it undervaluation, but as you say, it's just, it then potentially affects their ability to then raise a second round overseas.
Yeah, I think it's tough. It's not something that's going to be solved overnight. I think investors need to get smarter. They need to get more familiar with what it means to build a business on venture capital. You know, those valuations are low based on the burn that's required now to build a product. Yes, cost structures have come down, but it still costs a lot of money to put a good design team together, put a good, you know, front-end engineer, to get a good back-end engineer. It's something that hopefully will change over time as we see more successes in the marketplace. I think right now a lot of the exits have not got to the scale where entrepreneurs and investors make a lot of money, enough for them to say, hey, the pie is getting larger, let's be a little bit more flexible with valuations so that we can align ourselves right with the outcomes. So I'm just saying it's not easy. I don't think you can fix that because you have to deal with the constraints that currently exist. And that's why companies that do tend to grow to global scale here have succeeded on being bootstrapped because they've generated their own cash to be able to fuel that growth.
Yep, yep. And what about people who would say head on over to Silicon Valley to, you know, try and raise over there? I mean, you were kind of mentioning before that so much of it is about relationships anyway. So if they don't have the relationships, that's kind of a key part that's missing.
You know, as a startup, you want to be where you have the right resources to grow. And you know, if let's say you have enough capital and the resources you need are design engineers. Maybe you're better off going to LA than Silicon Valley. If the resources you need are salespeople, you might have a better chance being out in New York. If the resources you need to get off the ground is capital and none of it's available here, go find it somewhere else where it's available. But you can't just say go to Silicon Valley, because Silicon Valley is good for a certain category of resources, type of resources, and you need to figure out what your startup needs based on your approach, your business model, demographic you're going after.
Yep. Great advice. Now, I saw a question somewhere up the back there. Someone was raising. Yes?
Yeah, the angel investor firms overseas, are there certain firms that you think you would target to promote your products in a better way than others? And if so, which ones would you recommend at the top?
So that was, if you were going overseas to raise capital, are there certain firms that might be better for raising for particular types of products versus others, and what would those be?
Yeah, every firm has a different expertise, so they're going to be better suited to certain types of startups. I'm not going to name anyone. We can talk about it one-on-one. There is a multitude. There are a multitude of angel funds in the US, and the thing about institutionalized angel funds is that a lot of them don't tend to last past the first fund, and the reason for that is that angel funds typically structured 2-year life cycles. They invest in a whole bunch of startups, putting seed capital in, but their business model really is dependent on anteing up on their successes. But with a 2-year life cycle of a fund, you don't really get enough signals or enough traction in your current portfolio to be able to ante up in the successes. It takes a long time to build a startup. I said this before, a lot of people look at startups that get to scale fast as instant overnight successes, but it takes a long time to build these companies up. Most companies that you think about Pinterest, you think about Instagram, you think about Snapchat, you think even about Twitter, they've been around for anywhere from 2 to 4 years before they actually hit inflection when the rest of the world hears about it. So most seed funds don't tend to be around long enough. I would say if you're looking to raise, don't make a distinction between institutionalized seed funds versus angels that can actually really help your business, because it's the same thing.
Yes.
Just speaking a little bit about the future, so in 5 years' time, what do you see the environment being like? What's going to be the next big thing?
Oh, the next big thing? I don't know. Hopefully someone here will create it. I really don't know. What's that?
In your opinion, where's it moving towards?
It's hard to say. I mean, there's so many different areas that are being innovated on. Whether it's just the convergence between hardware and software. It's not going to happen when this device, instead of costing $140, it's going to cost $1.40. Right? It's going in that direction. Are you going to have disposable hardware? You're going to have built on top of the social graph a multitude of vertical sites that are creating niche audiences, and there'll be much fewer common threads of conversation between all of us, because not all of us are watching the same piece of content. Popular culture will still exist, but in what form? Alternative payment mechanisms. There are some companies here building stuff around cryptocurrency. It's not easy to predict what's going to be the next big thing, but the trends are that we are moving into a world where it's extremely connected. There is a lot of interest in social impact, because this is a generation run by millennials that have grown up with a notion that any small action can have a huge impact in a different part of the world, much more so than the generation that came before us. The world is a lot tighter now, and that's going to create a lot of new kinds of products that are going to be distributed because it's so easy to distribute. New products that are going to come out because there's an inundation of different types of content. How do we sift through that? We're also going to see a whole bunch of products, I think, that are going to hopefully make us feel a little bit more human as we start to exist more in the digital realm. Right now, being online feels like a very antisocial activity. That's going to change, in my opinion. So I don't know what the next big thing is, but hopefully when I see it, I'll be able to identify it.
Yes.
So Australia is in the same time zone as Indonesia and China.
Yeah.
And also educating Asia is Melbourne's #1 services export. So do you have any thoughts on, for local entrepreneurs, what should we be thinking about Asia?
So what is Jonathan's thoughts on how local entrepreneurs can take advantage of the Asian markets, particularly Indonesia and China?
So China is probably the only market outside of the US that's going to be able to support a pure play consumer company because it's got such a huge population and a growing middle class. So I would, as an entrepreneur outside of the US, try to really understand if I'm building a product company that's focused on consumers, and I'm sorry I'm using consumers as the example, we can talk about enterprise later, but if I'm focused on consumers, I would want to spend a lot of time understanding what the growth models are, what the distribution models are, to be able to penetrate Asia. The utility that you're going to provide through your app, that's going to be something that will come and go. But distribution models are relevant for a long time. So, the US distribution model is extremely organic. As we enter the mobile world, it's become very word of mouth driven. Growth hacking, as we used to call it in the Valley, is largely a web era notion. Mechanisms that you can put into the product for someone to click on more stuff, click to the next page, transact. Those things are giving way to different engagement models on the mobile web. And I think if you look at Asia, you're going to find a completely different landscape as well. Yeah.
Yes. Yes, you.
So after you invest in a company, what do you do? Like, how does the entrepreneur use you as a resource?
So the question was, after you invest in a company, what does the investor do? How does the startup use them as a resource?
So it depends on which stage of the company's life you invest in. At the early stage, hopefully you can be helpful, and it depends on the entrepreneur whether he identifies that you can be helpful. But we spend a lot of time as investors on the investment community really building up a network that hopefully is high leverage, but also building up a depth of experience on the operational issues. So an entrepreneur can come and say, hey, I need help with this particular issue. And hopefully an investor has enough experience to say, this is how you should deal with it. But at the end of the day, a venture investor is really just a support structure for entrepreneurs.
Do you have like an example of something really big you've done?
Yeah, but I can't really talk about it because it's so core to the product. But it fundamentally changed the potential of a very recent company I invested in, where if it were just going to be a communications product, there's a certain potential attached to it. But once it can become a broadcast mechanism, once it actually can capture identity, the potential for it just changes dramatically. And so how do you help an entrepreneur think through what that ambition can become? Operationally, those are all small things. Those are things that anyone can help you with, but it is our job to do it too.
Yes.
Our project has went over mentors who got us to get patents. Do you think in 2013 patents have any are important? And I know it's Brian might have something to say too.
Yeah.
Okay, question was, are patents relevant?
They're relevant later on in a company's life, not so relevant at the start where it's more critical to survive and it's all based on execution. So, if you're expending capital dollars to file patents rather than focusing it on the resources or bringing together resources to actually get your product out the door or scale your team in a meaningful way, it's probably the wrong focus.
Yes.
Snapchat, it's not generating any revenue at the moment. So how did you build a valuation on that? You've got X amount of users, but how did the investors see the value?
So the question was, when an app isn't being monetized yet, how is a valuation created?
So without speaking about Snapchat specifically, there are companies that are in the consumer pure play space that will monetize either through subscriptions, transactions, i.e. in-app purchases, or advertising. And advertising is one of the most scalable, outsized opportunities you can go after because it is directly tied to the value people have based on your audience and your understanding of their audience. The thing is, those take a long time because you do need to build up that audience. So, you can focus on in-app purchases, you can focus on the immediately monetizable. But the big idea really is around how do you build up that contextual understanding of a user, and how do you build up the growth model so that you keep scaling up so that you get a huge audience. And if you think of all the social products out there, there haven't been any social products where you're interacting with content independent of what that content is. You do not know what that content is until you engage with it. So that creates a really strong signal about engagement. But more importantly, it also gives a very strong signal on your relationship with the originator of that content. If you think about some of the other social products out there, when you click an engagement indicator, a like or a comment, a large part of it, because it's so contextually dependent, it is validation. You're validating maybe the originator of that content. Snapchat, for instance, you're clicking on a piece of content without knowing what it is, but I could have John and I could have Mike both sending me content. I don't know what that content is, but I choose to respond or engage with John's content first, and maybe 2 hours later when I have some spare time, I'm engaging with Mike's content. That already tells me the relationship, tells the platform the relationship I have with John and Mike relative to each other. You build up a very different graph, and that graph has a lot of value because advertisers just need more information about the audience that they're reaching, and they pay through the nose for it. So, there are going to be a proliferation of different kinds of products that are going to provide unique contextual understanding of the people that are using that product. And if your product also provides a utility, a real utility that you can't do without, you can monetize them directly too. And so you end up having really beautiful business models that can be built from it.
Okay, so we're going to finish up very shortly, so I'll take 2 more questions. Has anyone had their hand up for a while? I'm not sure now. We'll give some other people a go. You have for a while, up the back there.
What's the value of engaging an agent for a startup to not, in a sense, package their offer with a view to reaching some of these other capital markets?
So this was, what's the value of engaging an agent or a broker or someone who can help you to package up your startup?
I go out on a limb and say it's 0. At the end of the day, a good investment or a good fundraise is not a transaction. I say this often. Once you look at it as a transactional moment, you've lost the whole idea of what it means to raise capital, because it's a relationship that you're building up. And that's why I say all the investments that at least I've been involved in have taken a long time to get to know an entrepreneur. If you look at it as a transaction, you need to really quickly get over that trust hump, right? And a lot of investors do this by way of references. They would get all the other entrepreneurs to call this entrepreneur up and say, hey, this investor is trustworthy, et cetera, et cetera. But that happens. The other way is actually build a strong relationship. So when you bring a broker into play, you lose all ability to build up that trust. And if you're bringing it in just so that you have access or so that you know the landscape of investors that you could talk to, it's a strong indicator to the investor that you're not as resourceful as you should be. So I would personally avoid it. I'm sure other investors might have differing opinions, but I would avoid that.
Last question. I think you asked one before. Did you ask another one before? Yes.
You've talked a lot about consumer tonight. You mentioned enterprises, and I guess the challenges there are often quite different in that often you'll be tackling or pitching to institutions that are used to dealing with the old guard, you know, their trusted service providers, and people that are used to operating with those models. So have you been involved in helping startups and disruptors get into, I guess, a situation with large institutions where they can...
So with enterprise-focused companies, like I say, we are entering a world where product is driving most of that distribution. So good product is driving distribution. But yes, you're right. You still do have, in large enterprises, you still do have to have an enterprise sales model. A lot of the investments that General Catalyst does in the software as a service space, which are many, whether it's demandware, sometimes even big commerce, it's sort of an SMB play, which is kind of close to enterprise. You really help, or you try to help the entrepreneur think about what's the best way to get distribution. The grassroots approach, the Dropbox model of consumerization of enterprise, that's something that's very relevant this day and age. But once you get to more complex systems, once you get the stuff that needs to be integrated, sort of like payroll systems, you can't approach it the way you do a consumer product, because enterprises have to have the confidence that you're actually delivering real value and you're not going to fail. So that's why I say when raising capital, it depends on whether you're serving a much more forgiving user base or whether you're serving the enterprise. And even if you're serving the enterprise, there's certain applications that, the target market is a lot more forgiving. And that's where venture capital actually does come into play, because it's a capital source that understands the amount of effort that goes into providing a product that's actually baked. It's not just a quick lean startup, throw it out there, hopefully it sticks kind of a model. There's a serious side to the business.
Excellent. All right, so thank you so much for your time tonight, Jonathan. I did want to say one thing before you leave. If you could give everyone here one piece of advice to take away with themselves tonight, what would it be?
The best advice I give is just be completely self-aware about why you're doing what you're doing. Make sure that you really enjoy it. Why are you starting a company? Why are you joining a startup? Why are you working in a large company? You really need to figure out what your strengths and weaknesses are. And I think having that self-awareness is really going to help you think through who you need to bring around the table to bring your dreams to reality. I always say that we're all artists. All of us are artists, and all of us have something that we want to bring to the world. And if you're an artist, you have an intent you want to bring to the world, you need to figure a way to build it. Because if you're, use an analogy, if you're a table designer and you don't know woodworking, you have to find a woodworker, which means that along the way, at some point, some of your intent gets lost. And it may be improved upon, it may be actually lost in a negative way. But if you build up the skills necessary to be a woodworker, you can find a better woodworker than you. Or you can build it yourself, which means you can iterate faster. So be aware of what skills you have, be aware of what you need to augment, and make sure you're happy doing what you're doing. Life's too short.
Excellent. Thank you so much for joining us tonight, Jonathan.